All right. I hope everybody is doing good. If you all are ready, shall we start? So, today we are going to continue the part of episode 2020 of Riff Before You Quit. We discussed about how AI can take part as in trading as a portfolio manager, and today we are going to get inside the AI portfolio manager. So let's start. If you asked investors what artificial intelligence does in finance, the answer would probably sound familiar. It predicts stock prices. It tells you when to buy. It finds next Bitcoin. The those assumptions make for exciting headlines. Mhm. But they are largely incorrect. World's most sophisticated AI systems are not trying to predict tomorrow's price. They are trying to answer a far more important question. How should capital be managed right now? This distinction changes everything. Professional capital management is not about finding one perfect trade, it is about continuously answering thousands of small decisions. How much should be invested? How much should remain in cash? Which sectors are becoming overexposed? Where is volatility increasing? Which positions have become too large? Which assets are becoming highly correlated? How much downside exists if market reverses tomorrow? Should exposure increase or should it decrease? A modern AI portfolio manager evaluates these questions every second. Not once a day, not once an hour, continuously. Unlike human traders, artificial intelligence never stops monitoring the portfolio. Every market movement becomes another data point. Every trade updates probability. Every economic announcement recalculates risk. Every liquidity shift changes exposure. Portfolio management becomes a living system. Instead of asking what's the next trade, AI asks what's the healthiest portfolio. The subtle difference separates speculation from capital management. Inside AI Portfolio Manager, global market data, market scanner, risk engine, portfolio optimizer, allocation engine, execution infrastructure, continuous monitoring, and that repeats every second. BlackRock's Aladdin. One of the most influential financial technologies ever created is not a trading bot. It isn't even publicly available. It is called Aladdin. Developed by BlackRock, Aladdin has become one of the world's most advanced investment and risk management platforms. Today, the system helps oversee portfolios representing trillions of dollars in assets for financial institutions around the world. Despite popular belief, Aladdin is not an automated stock picker. It is something much more important. It is an infrastructure platform. Portfolio managers use it to understand risk before risk becomes visible. Every day, Aladdin analyzes enormous quantities of financial information, interest rate changes, bond yields, credit exposure, currency movements, commodity fluctuations, sector concentrations, portfolio correlations, macroeconomic scenarios, liquidity conditions. Stress testing, thousands of variables interact simultaneously. Instead of simply asking, will Apple stocks go up? The system asks, what happens to this entire portfolio if interest rates increase by 1%, oil falls 12%, and US dollar strengthens, and equity volatility doubles? This is institutional thinking, not predicting markets, preparing for possibilities. This distinction explains why the world's largest asset managers focus more on portfolio resilience than individual trade selection. Professional investing is rarely about finding certainty, it is about managing uncertainty. Let's look at the real market insight. During periods of market stress, institutions often run thousands of simulated scenarios before making allocation decisions. Instead of assuming one future, they evaluate hundreds of possible futures. This process is commonly known as scenario analysis or stress testing, allows portfolio managers to understand how different combinations of events could affect capital preservation. Retail investors rarely perform this type of analysis. Institutional infrastructure performs it continuously. Let's see how Aladdin thinks. Market data gets in and it determines interest rates. Then it looks at inflation, liquidity, correlation, volatility, portfolio exposure, risk score. Then it recommends capital allocation. Institutional systems optimize portfolios, not individual opinions. Why hedge funds hire engineers rather than traders? Walk into hedge fund 50 years ago and you would see mostly you will find only traders. Walk into many world's leading quantitative firms today and you will enter a different workforce. Mathematicians, computer science scientists, physicists, machine learning engineers, statisticians, data architects, software developers. This shift reflects a deeper transformation. Modern finance increasingly resembles an engineering discipline. If we take Renaissance Technologies, one of the most successful hedge funds in history, it was founded by Jim Simpsons, and the firm became legendary because it hired celebrity traders. It became legendary because it hired scientists. Its employees analyzed patterns that were invisible to discretionary traders. Rather than searching for opinions, they searched for statistical relationships. Tiny inefficiencies, possi- tiny inefficiencies, reoccurring possibilities, behavioral anomalies, execution advantages. When those advantages appeared, algorithms acted without hesitation, without emotion, without fatigue. The same philosophy can be seen at firms such as 2 Stigma, 2 Sigma, Citadel Securities, Jane Street. Those organizations process enormous data sets every day. Satellite imagery, weather patterns, shopping activity, credit card spending, social media sentiment, blockchain analysis, macroeconomic indicators, derivative positioning, alternative data. The objective is not to predict perfectly, it is to improve probability. Even a small improvement becomes powerful when repeated consistently across millions of transactions. The modern hedge fund. In the traditional firm and quant firm, this is a difference that we are going to talk about today. In traditional firm, there is trader, and traders have individual opinions and they place trades, and then there is result. In quantitative firm, there is data, there are models, there is probability, risk, execution, and continuous optimization. The competitive advantage has shifted from intuition to information processing. AI doesn't predict the future. One of the greatest misconceptions about artificial intelligence is that it predicts market with a certainty. It doesn't, and neither do institutions. Professional finance has never built around certainty. It has always been built around probability. Imagine flipping a coin. Nobody knows whether the next flip will land on heads, but everyone knows over thousands of flips the probability approaches 50%. Financial markets work in similar way. No institution knows exactly what Bitcoin will do tomorrow. No AI system can guarantee the next move in gold. No model can eliminate uncertainty. Instead, artificial intelligence attempts to answer a different question. Given everything happening right now, what is highest probability allocation? The single change in perspective transforms investment philosophy. Prediction seeks certainty. Probability manages uncertainty. This is why institutional investors often appear calm during volatile markets. Their systems are designed to adapt as probabilities change, not to defend predictions. The best AI systems become emotionally attached to forecasts. They continuously update them. Let's take real market example. Consider two portfolio managers during a sudden market correction. Manager A believes market will recover quickly. He refuses to reduce exposure because he wants to be right. Manager B allows probability-based system to evaluate changing volatility, liquidity, and downside risk. The system recommends reducing exposure by 20%, not because it knows the future, but because the probability distribution has changed. If markets recover, exposure can increase again. If markets continue falling, capital has already been protected. The objective is flexibility, not prediction. Prediction versus probability. Prediction is I know high conviction and higher emotional attachment and large mistakes. While probability is that it is likely to happen, continuous updates and adaptive allocation with controlled risk. Professional finance is built on probabilities, not certainty. Artificial intelligence is not replacing investors because it is smarter. It is replacing parts of investment process because it is more consistent. Machines never become overconfident after a winning streak. They never panic after losing one. They simply evaluate possibilities, monitor risk, and adjust capital accordingly. That is why world's largest institutions increasingly trust systems with decisions once reserved for humans. But one question still remains. How does how does artificial intelligence decide where capital should move? How does it balance growth, preservation, liquidity, and opportunity across changing markets? This is where autonomous capital allocation begins, and it forms the foundation of next stage of financial evolution. And on Monday, we will start learning about autonomous capital allocation. And after this Monday's session, probably by next Friday, next week, we will start discussing about the new feature that we are bringing on Rift. So from next Friday, we will be starting to discuss the upcoming new feature on Rift. Sure that more and more people join. From next Friday, a new feature is coming, and that feature is also a very big inclusion in terms of industry. We are going to accommodate one more segment of technology inside Rift. Uh-huh. And Rift is becoming bigger and bigger and going to cover most of these segments when it comes to trading, when it comes to, uh, you know, uh, crypto, blockchain, as well as stock markets, then followed by the commodities, everything at once. So, one space that covers one ecosystem that covers all aspects. All right. So, thank you so much. I will see you all on Monday. Come
Thank you.
on. Bye
Bye
bye.
bye.